Investing in options for beginners. Options are a form of derivative contract that gives buyers of the contracts, the option holders, the right, but not the obligation, to buy or sell a security at a chosen price at some point in the future. Option buyers are charged an amount called a premium by the sellers for such a right. Should market prices be unfavorable for option holders, they will let the option expire worthless and not exercise this right, ensuring that potential losses are not higher than the premium. On the other hand, if the market moves in the direction that makes this right more valuable, it makes use of it. Options are generally divided into call and put contracts. With a call option, the buyer of the contract purchases the right to buy the underlying asset in the future at a predetermined price, called exercise price or strike price. With a put option, the buyer acquires the right to sell the underlying asset in the future at the predetermined price. Let's take a look at some basic strategies that a beginner investor can use with calls or puts to limit their risk. The first two involve using options to place a direction bet with a limited downside if the bet goes wrong. The others involve hedging strategies laid on top of existing positions. Buying calls, long calls. There are some advantages to trading options for those looking to make a directional bet in the market. If you think the price of an asset will rise, you can buy a call option using less capital than the asset itself. At the same time, if the price instead falls, your losses are limited to the premium paid for the options and no more. This could be a preferred strategy for traders who are bullish or confident about a particular stock, exchange-traded fund, ETF, or index fund and want to limit risk. Want to utilize leverage to take advantage of rising prices. Options are essentially leveraged instruments in that they allow traders to amplify the potential upside benefit by using smaller amounts than would otherwise be required if trading the underlying asset itself. So, instead of laying out $10,000 to buy 100 shares of a $100 stock, you could hypothetically spend, say, $2,000 on a call contract with a strike price 10% higher than the current market price. Risk-reward. The trader's potential loss from a long call is limited to the premium paid. Potential profit is unlimited because the option payoff will increase along with the underlying asset price until expiration, and there is theoretically no limit to how high it can go. Buying puts, long puts. If a call option gives the holder the right to purchase the underlying at a set price before the contract expires, a put option gives the holder the right to sell the underlying at a set price. This is a preferred strategy for traders who are bearish on a particular stock, ETF, or index, but want to take on less risk than with a short selling strategy. Want to utilize leverage to take advantage of falling prices. A put option works effectively in the exact opposite direction from the way a call option does, with the put option gaining value as the price of the underlying decreases. Though short selling also allows a trader to profit from falling prices, the risk with a short position is unlimited because there is theoretically no limit to how high a price can rise. With a put option, if the underlying ends up higher than the option strike price, the option will simply expire worthless. Example. Say that you think the price of a stock is likely to decline from $60 to $50 or lower based on bad earnings, but you don't want to risk selling the stock short in case you are wrong. Instead, you can buy the $50 put for a premium of $2. If the stock does not fall below $50, or if indeed it rises, the most you will lose is the $2 premium. However, if you are right and the stock drops all the way to $45, you would make $3. $50 minus $45 less the $2 premium. Risk-reward. The potential loss on a long put is limited to the premium paid for the options. The maximum profit from the position is capped because the underlying price cannot drop below zero, but as with a long call option, the put option leverages the trader's return. Covered calls. Unlike the long call or long put, a covered call is a strategy that is overlaid onto an existing long position in the underlying asset. It is essentially an upside call that is sold in an amount that would cover that existing position size. In this way, the covered call writer collects the option premium as income, but also limits the upside potential of the underlying position. This is a preferred position for traders who expect no change or a slight increase in the underlying's price, collecting the full option premium, are willing to limit upside potential in exchange for some downside protection. A covered call strategy involves buying 100 shares of the underlying asset and selling a call option against those shares. When the trader sells the call, the option's premium is collected, thus lowering the cost basis on the shares and providing some downside protection. In return, by selling the option, the trader is agreeing to sell shares of the underlying at the option's strike price, thereby capping the trader's upside potential. For example, suppose a trader buys 1,000 shares of BP at $44 per share and simultaneously writes 10 call options, one contract for every 100 shares. With a strike price of $46 expiring in 1 month, at a cost of 25 cents per share, or $25 per contract and $250 total for the 10 contracts. The 25 cents premium reduces the cost basis on the shares to $43.75. So any drop in the underlying down to this point will be offset by the premium received from the option position, thus offering limited downside protection. If the share price rises above $46 before expiration, the short call option will be exercised or called away, meaning the trader will have to deliver the stock at the option strike price. In this case, the trader will make a profit of $2.25 per share, $46 strike price, $43.75 cost basis. However, this example implies the trader does not expect BP to move above $46 or significantly below $44 over the next month. As long as the shares do not rise above $46 and get called away before the options expire, the trader will keep the premium free and clear and can continue selling calls against the shares if desired. Risk-reward. If the share price rises above the strike price before expiration, the short call option can be exercised. And the trader will have to deliver shares of the underlying at the option strike price, even if it is below the market price. In exchange for this risk, a covered call strategy provides limited downside protection in the form of the premium received when selling the call option. Protective puts. A protective put involves buying a downside put in an amount to cover an existing position in the underlying asset. In effect, this strategy puts a lower floor below which you cannot lose more. Of course, you will have to pay for the option's premium. In this way, it acts as a sort of insurance policy against losses. This is a preferred strategy for traders who own the underlying asset and want downside protection. Thus, a protective put is a long put, like the strategy we discussed above. However, the goal, as the name implies, is downside protection versus attempting to profit from a downside move. If a trader owns shares with a bullish sentiment in the long run but wants to protect against a decline in the short run, they may purchase a protective put. If the price of the underlying increases and is above the put strike price at maturity, the option expires worthless and the trader loses the premium but still has the benefit of the increased underlying price. On the other hand, if the underlying price decreases, the trader's portfolio position loses value, but this loss is largely covered by the gain from the put option position. Hence, the position can effectively be thought of as an insurance strategy. Long straddles. Buying a straddle lets you capitalize on future volatility but without having to take a bet whether the move will be to the upside or downside. Either direction will profit. Here, an investor buys both a call option and a put option at the same strike price and expiration on the same underlying. Because it involves purchasing 2 at-the-money options, it is more expensive than some other strategies. Advantages and disadvantages of trading options. The biggest advantage to buying options is that you have great upside potential with losses limited only to the options premium. However, this can also be a drawback since options will expire worthless if the stock does not move enough to be in the money. This means that buying a lot of out-of-the-money options can be costly. Options can be very useful as a source of leverage and risk hedging. For example, a bullish investor who wishes to invest $1,000 in a company could potentially earn a far greater return by purchasing $1,000 worth of call options on that firm, as compared to buying $1,000 of that company's shares. In this sense, the call options provide the investor with a way to leverage their position by increasing their buying power. On the other hand, if that same investor already has exposure to that same company and wants to reduce that exposure, they could hedge their risk by selling put options against that company. The main disadvantage of options contracts is that they are complex and difficult to price. This is why options are often considered a more advanced investment vehicle, suitable only for experienced investors. In recent years, they have become increasingly popular among retail investors. Because of their capacity for outsized returns or losses, investors should make sure they fully understand the potential implications before entering into any options positions. Failing to do so can lead to devastating losses. That's it. Hope you like our video. Don't forget to subscribe our channel. Thanks for watching our video.